Hi friends, I am now giving you a video of around 2 hours to discuss entire financial management theory. FM theory has a weightage of around 10 marks in exam, 10 out of 15 marks. It can even go as high as 12 marks or 14 marks because some of the question can have extra theory requirement. But if you are confident on the practical area, you may not answer the theory part, but looking at the type of questions which are coming in exam and even your MTP, RTP, I feel that the difficulty level can be on the higher side in the practical side. So in that scenario, you will have to take help of theory. Your paper pattern has a 15 mark mandatory practical question, 10 mark practical, another 10 mark practical, another 10 mark theoretical question. Sometimes this 10 mark practical can have some theory as well. Mandatory you attend it, MCQ attend it. Out of the balance 20 marks, 2 out of 3. 2 out of 3. If you are not confident on a practical question, you will be forced to answer theory. So that is why we are learning this. And how will you cover theory? Using this material, page 3 to page 46 is my detailed theory and page 47 to 60 is my summary theory. I have recorded the videos with the summary theory. I have recorded the videos with the summary theory. But when you are looking at the screen, you will watch the detailed theory PDF. Keep the detailed theory PDF or keep the hard copy of the material with you and then keep seeing the video. You keep listening to the video only and then keep reading this. Pause it, read it. Pause it, read it. Whenever you want more clarity, pause it, read it. Because I am doing a quick explanation and you do a full reading, then automatically things will happen. 2 hours video, you can complete watching it in 3 hours by even reading the entire theory along with the playing of the video. So you play the video, keep listening to it, pause it at some stage, then go through the detailed theory, again play, again detailed theory, you can keep doing it and complete. And then in this process, you'll be able to complete your entire theory in 2 to 3 hours. Another option available if somebody doesn't want to do this is to go through detailed theory video, which I'm attaching here, which is a 10-hour video. You can watch that at maybe 1.5x. Because we are closer to exam, I feel a quicker discussion may be useful. That is why I'm releasing this. I am now taking you to the videos. Thank you, friends. Introduction. First chapter, scope and objectives of financial management, where we start with introduction. What is financial management? As the name indicates, financial management means managing finance. Very simple definition is managing money. That is the most important definition of financial management. We are trying to manage inflows and outflows of money. FM is concerned, that is financial management is concerned with two main things. One is your asset side of the balance sheet and the liability side of the balance sheet. Liability side is called financing decision, that is raising the money. I raise money in the form of equity, debt and preference, and investing them, which is the investment decision. So asset side part is called investment decision, liability side part is called financing decision, raising the money and investing them. Why are we doing this? We want to earn returns. We want to earn returns for our investors by using the fixed assets and current assets. Fixed assets, I produce the product, earn returns for the investor and distribute the same in the form of dividend. So three core things a financial management has. One is financing decision, investment decision and dividend decision. FM comprises of this is a definition: forecasting, planning, organizing, directing, coordinating and controlling of all the activities relating to, what is relating to? Acquisition of money, acquisition and application of money, with an objective. The objective is, I have some financial objective, we'll understand as we proceed. There's something called as wealth maximization, there's something called as profit maximization, which is better and all, you will understand. So financial management is basically managing money. It comprises of financing decision, investment decision and dividend decision. Financing decision is raising the money, investment is using that money in proper way and then ultimately paying dividends to our shareholders whatever money we have raised. Now, aspects of financial management, two key aspects of financial management, which I've already discussed. One is procurement of funds. Procurement is raising the money. Whenever I raise money, I need to balance risk, cost, and control. What is risk, cost, and control? Is I can raise money in the form of debt, in the form of equity. Preferences a kind of an hybrid instrument, or more or less it is like an equity. You can raise money in the form of debt or in the form of equity. Equity generally has high cost. The cost of equity is on the higher side. You would have learned this in the cost of capital chapter. This is on the lower side. Low cost, high cost. Equity is a high cost instrument. Debt is a low cost instrument. But equity has low risk from a company point of view. From a company point, not from an investor point of view. From a company point of view, it carries lower risk because I need not pay dividends in case my business is not performing well. So I carry lower risk. There is a lower risk from a company point of view. From a company point of view, there is a lower risk. Debt carries high risk. Whether business is doing well, not doing well, you will have to pay interest. You will have to pay interest. And this can lead to dilution of control. What is dilution of control? Is my shareholding can go down. As a promoter, if I issue equity, if I am 75% holder, it can go to 70, 60. So low risk, high cost, and dilution happens. The opposite is for debt. I need to decide which is better. Equity is better for me or debt is better for me. Effective utilization. What is effective utilization? Is whatever money you raise, please put it in fixed assets, working capital, and ensure that you earn a return which is higher than the cost of capital. Earn a return which is higher than the cost of capital. They basically earning positive NPV, earning higher IRR than the cost of capital. Once that happens, we will be able to meet the expectation of all the debt guys, preference guys, and equity guys, and also have surplus money for the company. The surplus money can be used for future expansion and other places. So surplus money can be there for the company. One element which you need to use risk and return. What is risk and return? If I take up a project, let's take example of Bharadwaj Institute. If I open another branch in Chennai, the risk can be on the lower side. Return can also be on the lower side for us because Bharadwaj Institute is known in Chennai, and if I open a branch here, I will have lower risk, but I'm not going to a new market, so sales may not increase significantly because already we have a branch here. If I open a branch in another place, risk goes on the higher side, but we can make huge returns also because we are now attracting newer market. Evolution of financial management. What is evolution of financial management? Is how did financial management importance kept changing? Originally, there was a traditional phase. Maybe you can see 1960s or 70s. This was considering that financial management, whatever you learn in the subject, is important only for occasional events like a merger happening, or an acquisition happening, or a takeover happening, or a liquidation happening, or an amalgamation happening. Only in these times you felt that okay, principles of financial management are critical. Let's learn them and employ them. Only during those times you thought financial management is important. Then came a transitional phase. From there, somewhere people felt no, this is important. So they said now the FM is used for day-to-day activities like fund analysis, cash budget, fund flow statement, cash flow statement. We entered a transitional phase, and then now we have reached a modern phase. In the modern phase, newer developments are happening. We learn about efficient markets, option pricing. What is option pricing? Is how do you value a call option or a put option? Multiple valuation models are there. These are the current stage in which the financial management has gone in. There was a traditional phase when we thought no, it is needed only for occasional events. Transitional phases where we thought it's for day-to-day activities, and modern phase where the importance of FM is increasing because you are getting aware of newer areas like efficient markets, option pricing, or valuation models. All these are the newer developments as far as FM is concerned. Then finance function. This can come in exam. What are the finance function? The finance function can be called as long-term finance function and short-term finance function. Long-term, I have already explained. investment, financing, and dividend. What is investment is where do I invest the money? Financing is from where do I raise the money? Dividend is how much of profit is to be distributed and how much is to be retained in the company. Short term is related to working capital. Last chapter, working capital, that is managing the day to day operations of the company and managing the day to day fund requirements, current assets minus current liability. Next, what is the need for financial management, or why do an organization need financial management? First thing is there are two objectives of financial management. First objective is wealth maximization. Second objective is profit maximization. So first thing is maximization of wealth can happen. Maximization of wealth can happen with the help of financial management. Maximization of wealth of the firm. Maximization of wealth of the firm by ensuring proper planning, controlling, organizing, directing, coordinating all the activities relating to raising of money. So one is maximization of wealth can happen. Apart from that, lot of other things where the utility of FM can help. Cost minimization, we learn this in cost accounting. How can I reduce the cost control and cost reduction? Maximizing the revenues by taking right decision. I should not do over investment in asset. Whenever an investment is to be done, I will go through a capital budgeting process. I'll go through a capital budgeting process. The capital budgeting process will ensure that I don't invest in those areas where investment is not to be done. Balancing the inflow and outflow, that is mapping of inflow and outflow through cash budget and other things. And tax planning can also be done. Now whatever I have discussed, if somebody wants in-depth explanation, that is why I said you should see this not with page 47 of my material, you should see this with page 3, which is where we have done question 1, we have done question 2, detailed explanation, we have done question 3, we have done question 4, investment decision, financing decision, dividend decision, working capital, and we have also done question 5, explain the need for financial management. So 5 questions I have discussed in a quicker way. That is why I am using that, but you should watch it only with the detailed theory. You watch it with detailed theory. I am going to explain with the quicker, shorter theory so that I do a quick explanation. You go through the detailed theory, and when you do revision, when you do revise, you can revise it with the shorter theory. Next, scope of financial management. What is scope is how much is the utility of the financial management. For example, at my home, we don't follow all the principles of financial management because we do not feel that there is a bigger need for the financial management to be applied at our home. So scope of financial management depends on size of enterprise. Reliance Industries, bigger company, large size company, may have a bigger finance team. A smaller company like Bharadwaj Institute may not have that much importance paid to this concept of financial management. Rate of growth, at what rate we are growing. If you are a high growth company, again you have to be doubly triply sure that you are not going wrong in anything. So that time again the scope of financial management will be on the higher side. Composition of assets and liability, that is what type of assets and liabilities we are having. If a lot of long term assets are there, lot of high risk liabilities are there, then again the need for FM is on the higher side. Now comes objectives of financial management. I think a question which keeps coming in exam, a very important exam question. One is they will ask what are the two objectives of financial management. They may also ask why wealth maximization is a superior as compared to profit maximization. Now, profit maximization is maximizing the profits of an organization. My decision making is always on the basis of profit maximization. Now, why this is not right? For example, if I do a smuggling activity, it can improve my profits, but there's a huge risk attached with it. There is a huge risk attached with. There is a legal risk which is also there. So, an organization which focuses on profit maximization may end up doing certain activities which they should not do. Maximization of profits only on the basis of profit maximization. This cannot be my sole objective. It is important, but cannot be my sole objective. It is a vague item. Sometimes risk is ignored. You ignore time value of money because profit is what you're making. Cash flow is not your focus. It's a narrow objective. What is narrow objective? I do not take care of all stakeholders. If I want to take care of my employees, I have to pay them good bonus, good salary. Profit maximization will say, no, let's not do all that. Let us focus on increasing profits for our shareholder. I am cheating my customer, I'm not making payments to my supplier on time. All these you may end up doing because profit maximization is a narrow objective. Wealth maximization or value maximization is making profits maximization in an ethical manner. Profit maximization you want to do, but in an ethical manner. Here objective is maximization of market value firm. Classic example is Satyam. Mahindra Satyam, a listed company. Now it's called Tech Mahindra. This was listed. It had lot of challenges. I think some 15 years back or something, where what they did is the promoter was doing something called as window dressing of the financial statements and was showing wrong profits in the books because he wanted to show higher profits because shareholders want more profits. So he was doing all this. One fine day, he announced saying that no, I have done all of this, and wealth profit maximization was happening. Wealth of the company went down by some 80-90% in a single day. So wealth maximization is a better objective, making profits in an ethical manner. Here you take care of all the stakeholders. Who are the stakeholders? Shareholder, lender, customer, supplier, employee, society, government. Pay taxes on time, do CSR activity for the society, pay good salaries to your employees, make prompt payment to your supplier, give good quality product to your customer, good at an affordable price, make prompt payment to your lender, give good dividends to your shareholder. All of this you will take care in a wealth maximization. In profit maximization, I take care only of the equity shareholder. So that is why wealth maximization is a broader objective and a better objective. What are the steps for maximization of shareholder wealth? The steps primarily involve these two: financing and investment. Financing and investment, these two you have to do properly. Financing and investment has to be done properly, where you have to consider time value of money in the analysis. There are investment decision techniques like payback method, accounting rate of return, which does not consider time value of money. No, you'll have to consider time value of money, do NPV or IRR technique, do a cost benefit analysis, focus on cash flow. Whenever we do investment decision, we focus on cash flows in various technique, except for ARR technique. Focus on all stakeholders, take care of shareholder, lender, customer, supplier, employee, society, and take a long term view. Don't even focus on a short term objective. Role of CFO. What is the role a CFO is playing? The three primary role is already known: investment decision, financing decision, dividend decision. Investment decision, financing decision, dividend decision, working capital management decision. How dividends are paid? By doing financial analysis and planning, technically ratio analysis or a cash flow statement or a fund flow statement. Apart from that, you can do planning, budgeting, pricing management, IT function, accounting related aspect, bookkeeping, forecasting. All this you can end up doing. Cost control, cost reduction, all of the CFO can do. Primarily the role is investment decision, financing decision, dividend decision, working capital management decision. But apart from that, planning, budgeting, pricing management, IT and HR function, accounting, cost control, cost reduction activities, doing financial analysis, deciding on the dividend decision is already discussed. So all these are role of CFO. Next, financial management and financial accounting. Financial management is managing money, whereas financial accounting is focusing on recording all the transaction. It focuses on recording all the transactions in our books of accounts. Technically, financial accounting is bookkeeping. So here, accounting focuses on accrual principle. Financial management focuses on cash flow. Cash flow is very, very critical. Here you focus on recording transaction, whereas after the transactions are recorded, I analyze the transaction. Which is what? Financial management. Technically, FM starts where accounting ends. FM is going to start wherever accounting is ending. Next concept, financial distress and insolvency. What is financial distress? It refers to a situation where a company is not able to meet its obligation. What is distress? I am not able to make my rental payment, I'm not able to make my interest payment, I'm not able to make my salary payment. If the distress continues for a longer period of time, it can lead to insolvency. If You are not able to pay rent for a very long period, not able to pay interest for a very long period, not able to repay debt for a very long period. If this keeps happening, this will ultimately lead to insolvency. Insolvency means company will be wound up. Next, agency problem. This is a very good concept. What is agency problem is, I have shareholder and I have board of directors. Shareholder will get more dividends, more share price if the company performs really well. Board of directors are the management. Management technically is taking all the decision, but they are not rewarded. They are not rewarded in case the company performs really well. They will not be directly rewarded. They may not be that much interested in the performance of the company, because they will try to, most of the time the shareholders and the board of directors may have good amount of linkage, but the point is business is owned by shareholder but managed by the managers, and managers may see that I will focus on my personal goal. What is my personal goal? Increase my salary, increase my perquisite, as compared to the organization goal. Organization wants to maximize wealth. So this is called as an agency problem. What is agency? Is the shareholders have given the authority to the financial manager, but these guys interest are different and the shareholder interest is different. This leads to a cost called agency cost. What is agency cost? Is extra cost I incur due to suboptimal decision making. Just to give a classic example, there's a good project. If you do this project, the company performance will improve significantly, and because of this, what will happen is shareholders will get good dividends, value of the company will go up. But the financial manager thinks that let us not do this project. Why should we put in extra efforts and all? Let us be doing the normal things. Let us not do some extra thing at this point of time. If I do this extra thing at this point of time, initially, whenever you do a project, losses can happen, and if losses happen, I will be questioned unnecessarily. Why to take all this headache? Let's not do the project, because he is acting in the personal interest. He is only bothered about his salary and his perquisite. He is not bothered about the interest of the company, which is where your managerial compensation can be linked to the profits of the organization. When you link it this way, the shareholders will expect then the managers to act in the best interest of the company rather than the best interest of their personal. They'll start acting in the best interest of the company. So this is an agency problem. Agency problem is business is managed by shareholders, whereas business is owned by shareholders but managed by financial manager. Financial manager, I'm an employee of the company. Why should I be bothered? Why should I be bothered about doing the best thing for the company? Because I am getting my salary, I am getting my perquisite. Let me not put extra work and all. I don't want to do any extra thing. Which is where if I link the managerial compensation to the profits of the organization, these guys may start performing better. With this, chapter 1 discussion gets over. Okay, we now move to chapter 2, which is on types of financing. Now, this is basically going to focus on raising money. The money which we raise can come in the form of equity, debt, preference, retain earnings. What are the different forms of preference there? What are the different types of debt there? What are bank facilities there? Non-bank facility, equity in what different forms it can come, basically related to raising of money. Here entire focus is on raising of money. First thing is, whatever financial need I have, I can categorize them into 3 categories: long term needs, which is more than 5 years; medium term needs, 1 to 5 years; and short term or current needs, less than 1 year. So these are the 3 categories of financial needs, self explanatory. Now, principles while selecting financial sources. What is financial sources? Is from where are you going to raise the money. One major principle is long term needs, you need to have long term sources. Short term needs, you need to have short term sources. Long term needs, long term sources, and short term needs, you need to have short term sources. Long term needs is if you are doing some fixed asset investment, for that I need to have a long term source. What is long term source? Equity or long term loans. For working capital purpose, I can take short term loans. So long term financial needs will have to be met of long term sources. Short term financial needs should be met out of short term sources. Example, any project you are doing fixed asset investment through long term like equity or preference or long-term debt, and any working capital can be met through short-term capital or short-term debt. Second is uncertainty element. What is uncertainty element? Is when the business is highly uncertain, that time I want more equity in the company. I don't want any debt or preference that time, because for debt I have to pay interest. I'm already having high uncertainty. How will I pay interest? So during uncertainty stage, equity is better. And as uncertainty goes down, then I can bring debt or I can bring preference. But whenever I'm in an uncertain stage, when I'm starting a business, it is better to have more of equity. Classification of financial sources: one is based on in source, which is internal source, or external source. Internal source where only one form, which is retained earnings, and external you can have equity, preference, debt. Lot of different forms of debt is there in the practical world. And based on maturity profile is, as you saw, this long term financial needs, medium term financial needs, short term financial needs. So long term borrowing, medium term borrowing, short term borrowing, or long term capital source, medium term capital source, short term capital source. Long term greater than 5 years, medium term could be 1 to 5 years, and short term are less than 1 year. Now comes the first form of main capital. The main first form, equity capital or external equity. This is one a permanent source of capital. There is no repayment which I do unless I do a buyback or something. Permanent source of capital. Ideally, this is what organization will take whenever there is uncertainty element, whenever I'm starting a business, whenever I need it for long term purpose. So first thing is this called as equity. There are a lot of advantages of equity. It is a permanent capital. I have a flexibility in paying dividend. If I don't have profits, I'll not pay dividend. If I'm having profits, I'll pay dividend. So there is a good amount of flexibility which is there. A rights issue can happen, with which I can raise money from my existing shareholder. And whenever I'm able to take equity in the business, I'll be able to then raise other form of capital. Whenever I want to take a borrowing, first thing they'll ask is how much is your money into the business. If you have put your own money in the business, then they will try to give any borrowing or any preference. So ability to take other forms of capital is highly dependent on equity. Certain disadvantages. The most important disadvantage is high cost. What is high cost? Is higher dividends you have to pay. And when you do your cost of equity calculation, you will understand that dividends are not tax deductible. So, and growth, there should be a continuous growth in the organization. So because of which there is a high cost attached with it, and there can be a dilution of control or ownership. This is what I had done even in the earlier segment. Equity, low risk, high cost, dilution of control. Then comes the preference capital. Preference capital is, it enjoys preferential rights over equity shareholder as far as dividend payment is concerned and repayment of capital on the liquidation. There are multiple forms of preference capital. There are cumulative, non-cumulative, secured, non. So multiple categories are there. Primarily cumulative and non-cumulative. Advantages: no dilution. So impact on EPS could be very limited. There can be still an impact on EPS because EAES go down. No dilution of control or ownership. Disadvantage: huge disadvantages. No tax deduction on dividend. Normally cumulative in nature. Because it's cumulative in nature, you will have to anyway pay. You will have to anyway pay. If you're not paying now, later on you'll have to pay a higher amount, because you'll have to accumulate them together and make the payment. So preference capital again is a high risk kind of an instrument like debt. Like debt, it is a high risk instrument, but no dilution. And this can have medium cost. In fact, I feel it can have even the preference. Okay, preference will have medium cost and debt will have the lowest cost because of the tax benefit. Sorry. Retained earnings are internal equity. Best thing which can be possible is if I have my own source of money, that is, if I have my own retained earnings in the business, I retain them and then take care of the investment requirements. But there are certain disadvantages with internal equity also, because there can be a need for the shareholder saying that you please give us. So there is limited money which only I can have in the form of retained earnings. It's a permanent source of finance. Retention can help me in future growth. No dilution of control, no extra cost. These are self-explanatory items, so I don't want to explain much here. The only problem is limited availability of retained earnings. Debentures, lowest cost because interest is on the lower side. Tax benefit is there. No dilution of control. Risk is higher because this can lead to increase in financial leverage or increase in financial risk. Increase in financial leverage or increase in risk because you have to pay a fixed amount. You have to keep paying a fixed amount. So that is a problem with the debenture. The summary is equity low risk, preference and debentures high risk. From a cost point of view, equity has high cost, preference has medium cost, debt has low cost, and equity will have dilution of control, preference and debt will not have dilution of control. Okay, now we are going to discuss this debt category little bit in depth. I have listed down the main debt categories, but there can be more also. In the detailed theory you will see. First is callable bond versus a puttable bond. A callable bond means the issuer, call option and put option. You learn this at final level, not very critical for you. Call option means the issuer means the company have the right to redeem this before maturity. The company have the right to redeem this before maturity. Puttable bond means you are the investor or I am the investor in a company. I have the right to ask for redemption before maturity. I have the right to ask for redemption before maturity. Callable bond, company has the right to redeem before maturity, and puttable bond, I have the right to ask the company to redeem it before maturity. There are other bond categories: floating bond and fixed bond. A fixed bond will pay fixed rate of interest 10%, 11%, 12%. A floating rate bond will pay a floating interest based on some benchmark. What can be the benchmark? They may say repo rate, RBI's repo rate plus something, or they may say treasury bill rate, government treasury bill rate plus some percentage, PPF rate plus some percentage, PF rate plus some percentage. So some benchmark will be there, and if the benchmark rate undergoes a change, the floating rate interest will also undergo a change. Next, foreign bond and masala bond. Now, what is foreign bond is for an Indian investor, any bond which is non-INR denominated, any bond. For example, I invest in a USA bond. I invest in a company which is in USA and invest in their bond, that is called a foreign bond or an euro bond. I invest in a UK company. I invest in a Japanese company, that is called foreign bond or euro bond. What is masala bond is for the overseas investor, people who are in US, if they invest in INR bond, it is called masala bond. Foreign bond for us it is a foreign bond. For them an Indian bond is a foreign bond. For the people who are investing from US and other places, for them a bond in India is technically a foreign bond. A bond in India is technically a foreign bond for them. But theoretically, what we call it as masala bond, INR bond, which is sold to an overseas investor. Treasury bill, these are issued by government of India. They are risk-free in nature. They are issued for a varied period of time. Municipal bonds are issued by various municipal corporations, primarily used for development of infra, roads, dams, canals. All this can be developed with the help of this. These are other bond category. Is this the only limit? No, I think your material has a lot of things. I have tried giving only the important ones. So there's a callable bond, puttable bond. You have foreign currency convertible bond. These are bonds which can be converted into equity. Foreign currency convertible bond, plain vanilla bond, foreign currency convertible rate note, drop log bond, variable rate. I have multiple categories are there. You can go through all this if you want. But primarily the major one I have explained. Next, commercial bank. This is another place from where I can borrow money. Commercial bank are example ICICI Bank, your Kotak Bank, caters to the short-term requirement as well as long-term requirement of business. They can provide working capital funding as well as long-term funding. Primarily, most of the corporates are dependent on commercial banks for raising the money for their short-term needs and the long-term needs. Bridge financing. What is bridge financing? Is I plan to do a project. Now, for doing the project, I need money today. I'm planning to get equity after some month 3 or month 6. Some money is going to come later in month 3 or month 6. It could be in the form of equity or it could be in the form of a long-term loan. It is for this project. Money is going to come later. Bridge. I want to bridge the gap for this 3 months. I want to start the project immediately. Money is going to come later in the form of a long-term loan or an equity. Bridge financing is a short-term loan taken pending disbursement of a long-term loan or an equity which is already sanctioned or likely to be sanctioned. In this short term gap, in this gap, I need bridge financing, and this will be repaid once the long term loan comes in. Bridge financing can be asked in exam. Bridge financing is to bridge the gap for a shorter period of time. Venture capital financing. You could have seen a show called a Shark Tank, where there are a lot of investors, like angel investors, who are investing money. Venture capital are institutional funds. They are institutional funds which are involved in providing equity or debt financing for the inexperienced entrepreneur. People who are having a good idea but are not having money may go through a venture capital route. They may go through a venture capital route where I may get equity or debt financing. This can become a source of long term finance, and normally the VC partner, you would have seen in Shark Tank, these people who are investing, they are not technically VC, they are technically angel investor, but these people can assist you in management, planning, providing network contacts, organizing your business, taking care of certain new requirements. All these, the venture capital funds can assist you. They'll not directly do, but they can assist you in all of this. Now, in what forms will I get the money? Best is equity financing, getting it in the form of equity, because I am having lot of worries in my business. I'm starting a new business, so best form is getting it in the form of equity. Second is conditional loan. What is conditional loan? Is I do not charge any interest on the loan, but you have to pay royalty as a percentage of sale. Whenever your business is doing well, based on the sales you are doing, you'll have to pay royalty, which can vary from 2% to 10, 15%. Income note, I will have a lower interest on loan as well as a royalty. Both income notice, you have to pay interest as well as royalty, but the rate of interest could be on the lower side. And participating debentures, this is another form. See, equity financing is one form, all the other are debt. Conditional loan, income note, participating debenture. In this, you don't charge interest during the initial period because you are uncertain phase. As the business becomes established, interest can be charged, and the same can increase also, I'll start charging interest, and the same can increase in future. Securitization. Okay, this is another concept which you learn in depth at CA final, but let's understand what is securitization. Now let's take an example of ICICI Bank. They have given lot of personal loans. They have given lot of personal loans. So 1 lakh people, 2 lakh people have given personal loan. Now the repayments will happen over a period of let's take housing loan, not personal loan, housing loan. This will be repaid over a period of 20 years, 15 years. Personal loan can also be taken. Housing loan, 20 years. Now ICICI Bank is in need of some money. ICICI Bank is in need of some money because their business is what? They are lending money and taking deposits from public, or taking money from lot of investors and giving loans to various companies and individuals. Now ICICI Bank has a loan book of some 1,000 crores. Housing loan is there. There can be multiple housing loan category. One of the loan category, they have 1,000 crore loan. Now I want money immediately. I cannot tell my customer to pay this. So what ICICI Bank will do is they will transfer this to a company called ICICI SPV, or you can name it as ICICI Securitization or ICICI Security, some name. You transfer this money, entire 1,000 crore loan, you transfer it to them. That is, this is an asset for me. For ICICI Bank, it's an asset. I transfer my asset to another entity. This ICICI Bank is called an originator. This entity, what they will do is, if I prepare their balance sheet, they will have this loan in their asset side. They will raise money in the form of equity, mostly equity from investors. They may raise some 1,000 crore or something, and this money will be paid to ICICI Bank now itself. This money will be paid to ICICI Bank now itself. What is securitization? ICICI Bank has a 1,000 crore loan. They want immediate money, so they transfer it to an SPV, and ICICI Bank will transfer this to the SPV. SPV will give me 1,000 crore today. SPV will give me 1,000 crore today. What will the SPV do? They will keep collecting money on a regular basis from the individual public where they have taken loan, and of that income, with that income, They will pay to the investor. To the investor, whoever has invested in this SPV, they will pay. So securitization is a process of conversion of illiquid security into a marketable one. Origination function, which is giving loan to the borrower. Pooling, similar loans are clubbed together, transfer to an SPV and issue the security to the investor. Normally non-recourse. What is non-recourse? Is any bad debt or any credit risk happens, any insolvency happen of the borrower, this risk will be borne by the SPV or the investor. There can be recourse also, but normally it is non-recourse. Non-recourse means the SPV or the investor will take care of the risk. Securitization is a process of converting illiquid. Illiquid is the 1,000 crore loan book is an illiquid one. I convert into a marketable one, take money from the SPV, and SPV issues securities to the investor, raises money from them, collects money from the borrower, and keeps paying interest income to the investor, and some principal can also be paid back as and when time arises. Okay, next form of raising money is can also be lease financing. What is lease financing is, I want an asset. One option is to buy the asset. Buying the asset, you need money. Second option is to take the asset on renting, which is called alternative to purchase of asset, can also be called as renting of asset. The chapter focuses you want some asset. Where is the money going to come from? Here we are saying let's not even buy the asset. Let's take it on rent. There are two types of lease. One is called operating lease, where I am only the user of the asset and the risk and the reward of the asset continues to be with the lessor. Lessor will take care of repairs, maintenance, and example, renting of building. I'll not become the owner after usage of the building. Second option is financial lease. Lease is the user, but is also likely to get ownership. You would have learned about financial lease and operating lease in accounting standard. In operating lease, I'm only the user of the asset. I'm not going to become the owner. The risk and reward continues to be with the owner. Here, I'm the user, but likely to get ownership if I pay all the payments on time properly. Finally, I'll become the owner. Normally, fully payout. Fully payout means in one lease, the entire money will be recovered by the lessor. It is nothing but a loan in disguise. Example, purchase of car. When you purchase a car, you can enter into a financial lease arrangement. Now, other than this, are there other lease arrangement? Yes. There's a sale and a lease back arrangement. What is sale and a lease back arrangement is, I am in need of money. I am the owner of the asset. I sell the building and take the building back on rent. I sell the building and take the building back on rent. So I get a huge money. Initially, I need some money. Leverage lease. What is leverage leases? The owner buys the asset by taking debt. Buys the asset by taking debt. How will I repay the debt? With the help of the lease payments. With the help of, so I take an asset, I buy an asset through debt and then lease this asset to someone else, get regular income from that asset and repay the interest on the debt. Sales aid lease. What is sales aid leases? The lessor is saying, I will help in marketing or sales of the manufacturer product. There is a manufacturer who has an asset. I'll help you in marketing or sale of your product by taking the product from you. For example, take any Maruti Suzuki. I am a lessor. I take 100 cars of Maruti Suzuki on lease from them. Basically, on lease means I buy them. I buy them and I get commission from Maruti Suzuki or maybe credit, and I also lease it out to someone else and earn income out of it. Earn sales aided lease. Close ended lease means asset will get transferred to the lessor at the end of the period. Example, operating lease, renting of building. Open ended lease means lessee has the option of getting ownership. Example, financial lease. Forms of short term finance. What is short term finances? Less than 1 year period. Trade credit. Trade credit is creditors. Accrued expenses. You do not pay your expenses on time. There is some credit you get. Deferred income. Income received in advance. You can get advances from the customer. Commercial paper is a very good thing. This is issued only by high credit worthy companies. High credit worthy companies means companies whose financials are very strong. Not a small company and all cannot issue commercial paper. Issued by high credit worthy companies. This is also called as a money market instrument. Money market instrument are those instruments which have a life of less than 1 year, and these are normally bought by bigger companies like banks, mutual fund, financial institution. That is why a small company and all cannot issue commercial paper. Treasury bill issued by government. Certificate of deposit is nothing but a fixed deposit. bank advances, which is short-term loans from bank, intercorporate means I take money from other companies, and public deposit, which is loan from public. These are the various forms in which I can raise my short-term finance. Trade credit, outstanding expenses, income received in advance, advance from customer, commercial paper, treasury bills, certificate of deposit, bank advances, intercorporate deposit, and public deposit. Then facilities provided by bank. What are the facilities which can be provided bank? Will be self-explanatory. Short-term loans, and OD facility can be provided. OD facility is a limit given by a bank. This can be a clean OD where you do not have any security or collateral to be given. A cash credit and OD is more or less similar. It is a limit given by the bank for funding my working capital requirement. You would have learned this in working capital chapter, where we go to the bank by telling them these are the working capital requirements of us, and against this please give us a loan. You can get advances against the goods which you are buying, bills discounting, or financing of export trade, which I'll discuss a little bit in depth. Pre-shipment and post-shipment. For export, there's a pre-shipment. What is pre-shipment? Is before I sell. Before I sell. So before I sell, I need money to buy inventory, funding of inventory, because I need pre-shipment, I need money for inventory. Before shipment, inventory for purchasing. After shipment, for debtor, because money has not come in, no, inventory is over. So pre-shipment has to be closed. Now you have to get into post-shipment. Loan extended by a bank for purchase of raw material, processing and completion of manufacturing and export order. This is money used before shipment of goods. Mostly we call it as packing credit. Pre-shipment packing credit. Clean packing credit means without any security, or packing credit against hypothecation of goods or against pledge of goods. And for getting this credit, many a times for getting this loan, banks may ask me to take an insurance cover. Export Credit Guarantee Corporation cover, ECGC cover. What is this cover? This is an insurance cover which will compensate this guy who is exporting the product in case the importer is not able to make the payment, and I have to take a forward contract for hedging a foreign currency risk. What is foreign currency risk? Is in case dollar keeps moving up and moving down, there is a risk for the company. That risk can be sorted out or can be taken care with a forward contract. What is post shipment? Funding of debtor. You have already sold the product, so there is a bill of exchange which would have been done. So you can do discounting of bill or advanced against bills, and sometimes some export incentives and all will come for export. These incentives may not come on time, so I may generate, because incentives have to come from the government side, there can be delay, there can be an advance against the export incentives as well. Pre-shipment creditors against inventory, post-shipment creditors against debtors. Seed capital, this is designed by IDBI. This is to provide the initial capital to start a business, useful for skilled, experienced entrepreneur, but they do not have the financial resources. They do not have the financial resources. Interest is normally not charged on this. Some service charge will be there, and repayment will be based on the repaying ability of the company. The seed capital is usually for a shorter investment of less than 2 CR, and the seed capital amount is also very less. It is given normally by IDBI. It is for people who do not have the financial resources but they want to start a project. 50% of the promoter contribution or 15 lakhs, whichever is lower. It will be in the form of a debt, but interest is not charged initially. Later on, you may charge interest also. Fixed service charge will be there. Repayments are fixed based on the repaying ability of the company. Unsecured loan. As the name indicates, there is no security against this. Contribution by promoter in the form of unsecured loan. Promoter is giving loans to the company without taking any security from the company. Why promoter is giving loans? See, promoter can bring in the form of equity. Equity is a permanent capital that cannot be returned. But loan can be returned to the promoter. So promoter will bring in this unsecured loan. The rate of interest will be lower than the bank loan and all, and it will be subordinate. What is subordinate is, you cannot repay the unsecured loan till you're repaying the bank loan. You cannot repay. Subordinate. This is a normal condition in the practical world. Subordinate. USL are subordinate to bank loan. Loans cannot be repaid till the bank loans are fully repaid. Next, capital incentives. These are given by government for setting up project in some backward area. I want to develop a backward area. It can be in the form of a subsidy, or a grant, a power subsidy can be there, indirect tax exemption can be there, direct tax exemption can be there. All these incentives are given so that a person invest. The entire focus of the chapter is where is the money going to come from. So government can also support in the form of a subsidy, power subsidy, indirect tax subsidy, direct tax exemption. Next, deep discount bond or zero coupon bond. As the name indicates, there is no interest paid on this bond. Deep discount. What is deep discount? 1 lakh is the face value. It will be issued for 2000 rupees. Deep discount issued. What? And this will be repaid after maybe some 15 years, 20 years. So the gap of 1 lakh and 2000 is the income of the investor. Huge discount to the issue price. Secured premium note. This is another form. What is secured premium notice? It is a loan and there is a warrant along with that loan. You have to pay interest and you have to repay, and there is a detachable warrant which as an investor I can convert this into equity share. I can convert this into equity share. Another, there are various variants. Option bonds. What is option bond? Is there is an option for the investor. He can get interest periodically or at one time. When you create a fixed deposit in a bank, you can either get every year interest income, or you will say the interest, let it be reinvested with the FD and I'll get back the FD interest at one time on the maturity. Inflation bonds. It is a type of a floating rate bond. Floating rate bond is based on some benchmark. Inflation bond is based on inflation. That is, rate of interest will change based on the inflation. Based on the inflation. Okay. Now comes another category, ESG bonds, environmental, social, and governance bond. They are also called as green bonds or good bonds or social bonds. ESG bonds, this is basically a category which is growing a lot in the practical world. ESG basically ensures that I focus on people, I focus on planet, I also focus on profit. This is called 3P framework. ESG. People is taking care of employees, taking care of society, planet, taking care of the environment. So ESG bonds basically says that we have to take care of people, planet, as well as governance. When you do this, it will be a long-term sustainable organization. Long-term sustainable organization. So these are issued for projects having good environmental impact, green bonds, good social impact, social bonds. It is normally for a specific target, longer period, can be a combination of green bond and social bond, and the rate of interest is normally on the lower side. The rate of interest here is on the lower side. Next, American depository receipt, global depository receipt, Indian depository receipt. I'll first quickly explain this. What is depository receipt is? It is equal to 10 equity share, 15 equity share, 20 equity share, 5 equity share. We convert a number of equity share into one depository receipt. So what I do in a practical world is I am Infosys. I deposit 50 lakh shares, 50 lakh shares with a custodian bank, and against this I get 10 lakh depository receipt, 10 lakh DR, 10 lakh depository receipt against what? 50 lakh shares. This equity shares are there, but I don't issue the equity shares. I keep it and issue depository receipt against this. On the depository receipt, I will have to pay dividend. Like I pay dividend on equity share, I'll have to pay dividend on depository receipt. This depository receipt can be issued in USA, can be issued in USA by Infosys, can be issued in USA by Infosys, then it's called American depository receipt because it will be issued in US currency. You can issue it in non-USA like Euro or Pound, then it is called global depository receipt. And Indian depository receipt means a foreign company issuing a depository receipt in India. IDR is INR denominated, ADR American is USD denominated, GDR is non-USD denominated, and IDR is INR denominated, and this will be listed in the local stock exchange. It is more or less like an equity share. If the share price in equity market goes up, the depository receipt price will go up. You pay dividend here, you will pay dividend. Voting rights may not be there. So ADR, GDR or IDR is exactly same. 1 DR is equal to specific number of shares which are deposited with a custodian bank or a trust. Dividends will be paid. It is exactly like an equity share. ADR means what is American depository receipt? US dollar denominated. What is global deposit receipt? Non-US dollar. Could be Euro, Pound, Yen, some other currency. IDR is INR denominated. Next, Last two segment, crowdfunding. Now I want to raise money, bank is not giving me money, seed capital is not coming in, I'm not able to raise in the form of venture capital, then I can go for crowdfunding. Crowdfunding is raising money through social media or website. This can also be called as donation based funding, and there are lot of apps which help in doing this, lot of websites. And it can also be in equity funding. What is donation based funding is, I'm donating for a good cause and I forget it. Equity funding means I give money and get some equity share, Crowdfunding intermediary can charge me certain fees for this service, but crowdfunding is raising money from lot of people, Other option is peer to peer lending. What is peer to peer lending is, company A lending it to company B through an intermediary. Matching of lender with the borrower through an intermediary. Normally, loans could be of unsecured nature. Now, we have discussed chapter 2. Again, in depth discussion I have tried doing, but there can be something more in the bigger material. You can go through the bigger material to have detailed explanation. But from a quick discussion or exam point of view, whatever I have discussed now should be sufficient as far as exam is concerned. But in case you want more clarity, obviously you will have to go through the longer explanation where we have a lot of things which have been explained here. If you go through it, you will understand. But I have tried covering it in the shorter way. With this chapter gets over. Okay, we move to chapter 3, not a very important chapter from theory discussion point of view, but still I'll do it. Ratio analysis, also technically called as financial analysis. Ratio analysis is basically going to do comparison of two related items. The items can be related like sales, profit, net profit, margin, or current asset, current liability, current ratio. They are related in some manner. Two related item. These related item can come from P&L. Net profit, sales can come from balance sheet. Current asset, current liability. One from P&L, one from balance sheet. Asset turnover ratio. Asset is from balance sheet, sales is from P&L. So it can be from P&L, it can be from balance sheet, it can be outside the P&L balance sheet as well. And we express the same as a mathematical item. What is mathematical item? Can be in percentage, can be in times, can be in days, can be in ratio, which is what ratio analysis is all about. Now, what are the data sources for this? The data sources is P&L, balance sheet, notes to accounts. P&L, balance sheet, notes to accounts, cash flow statement, which is what your financial statement is all about, and non-financial data. Bharadwaj Institute may calculate student teacher ratio, which is non-financial information. What is the purpose? Purpose is to assess the performance of the company, identify where I am good, liquidity is good, profitability is bad, turnover is effectiveness is good, ROI is bad, ROE is good, identify strength and weakness, and then do decision making. What type of comparison can I do? I can do comparison of my company in the same year, same company but across different years, my company with competitor, my company with industry, my company with economy. EIC, economic, industry and company analysis. This is EIC analysis, part of fundamental analysis you learned at final level. So I can compare my performance with economy, with industry, with competitor, and my own self across different years. What are the different types of ratios we use? Shareholders use ratios for profitability ratio like your ROE, ROI. Investor uses profitability ratio. Shareholder investor is almost same. Profitability, but also solvency. Solvency is basically whether the ability of the company to repay its long-term liability. We have debt ratio, equity ratio. Lender will look at whether interest coverage is there, debt service coverage is sufficient, and solvency. Creditor, liquidity ratio, that is current ratio and quick ratio. Employees may look at all the ratios, financial manager may look at all the ratio, executive manager may look at, regulator, government may look at profitability ratios, because they wouldn't want the company to make huge profits at the expense of the customer. Production manager may look at ratio like input output ratio, raw material consumption ratio. Sales manager may look at sales related ratio like sales per employee, sales per square feet. Industry specific we have ratios. Telecom revenue per user, bank operating expense and income ratio. Telecom is revenue per user, bank operating expense and income ratio. Bank uses a ratio called net interest margin. Transport, you would have learnt in costing, cost per ton kilometer, passenger kilometer. Hotel occupancy ratio. Now, what are the utility of ratios as far as decision making is concerned? We have different categories of ratio which you need to be aware of. There is a liquidity ratio, short term solvency, capital structure ratio, long term solvency, turnover ratio, effectiveness of usage of resources, profitability ratio relation to sales related to owner's point of view, and there can be an inter firm comparison or an intra firm comparison, and also ultimately for budgeting. Budgeting is preparation of forecasted financial statement. Entire chapter of ratio analysis, you would have done this, that they give lot of ratios and we forecast the financial statement with the help of that. Limitation of financial ratio. What is limitation? Inflation impact. If inflation increases, my financial will start showing higher sales, higher profits, but in reality the profits are not higher because of the inflation. Inflation can distort my numbers. Seasonal factor. What is seasonal factor? Some companies in the month of March can have very high inventory, very high debtor. Some companies may not have any inventory or debtors in the month of March because sales do not happen there, production do not happen in the month of March. Sugar cane processing, those industries, as per the season, their financials can undergo change. Window dressing, example Mahindra Satyam, they did window dressing so that they have better ROE, better ROCE. No standard ratio, there's nothing like standard ratio. The way I calculate debt service coverage ratio, way another entity calculates, can have some variation. I've explained this when we do question and all. ROE can be different in different industry, and what ratios to use, that is also not standardized. Conclusion from the ratio depends on the company, industry, state of economy, EIC. If you have multi-product or multiple segment, again ratio analysis can become little challenging. And in case there is a change in accounting policy, again ratios can get impacted. These are limitations of the ratio because of the impact which arises due to various factors. Now we have two types of analysis. This may come in exam: horizontal analysis versus vertical analysis. Horizontal analysis is company year 1, year 2, year 3, year 4. You analyze your own ratio with year 1 net profit ratio, with year 2 net profit ratio, year 3 net profit ratio, year 4 net profit. That is called horizontal analysis. Vertical analysis is comparison of 1 year ratio, 2025 ratio of TCS with Infosys, with CTS, with other companies in the industry. So with other company, with the industry, with the economy. So vertical analysis is outside the company, horizontal analysis within the company but across multiple years, and vertical analysis same year but different companies. Very simple discussion. I think I would have taken around some 7-8 minutes to discuss this chapter on ratio analysis. Very simple chapter, not much tested from an exam point of view as far as theory is concerned. With this chapter gets over. Okay, I move to chapter 4. Technically, not much is there in this chapter. One is, what is cost of capital? This is the minimum return which my investor wants. This is also the discount rate which I use in capital budgeting, hurdle rate or the cutoff rate. This can be used for evaluation of investment, project, business, and selection of the right credit policy of the company. So evaluation of investments, projects, business, credit policy decision, all this can be done with the help of cost of capital, because whatever projects I'm doing, it should meet the at least the cost of capital which is there. One point which I may discuss a little bit more is types of risk. There are two types of risk. One is called systematic risk and unsystematic risk. This risk impacts all companies. Systematic risks impacts all companies. This is a macro risk or economy level risk. This is a economy level macro factors, inflation, interest, which will impact all the companies. Whatever risk you see in a company, it can be because of macro factors or micro factors. Micro factors called unsystematic risk. Systematic risk is otherwise called as non-diversifiable. Why it is called non-diversifiable? Because even if you diversify into multiple businesses, you cannot eliminate the risk. You cannot. Systematic risk is something which is going. If Indian economy inflation goes up significantly, every company will get impacted. So systematic risk will impact all the companies. Unsystematic risk is going to impact a specific company, and it can be eliminated. It can be eliminated through a process of diversification. It can be eliminated through a process of diversification, which is what unsystematic risk is all about. With this chapter gets over. Okay, we now proceed to chapter 5, which is on capital structure. And the first question itself is, what is capital structure? We have seen this when we did problem solving. Capital structure is basically the combination of debt, equity, and preference. In equity, we have internal equity as well as external equity, and the objective is to minimize the cost of capital, minimize WACC. Objective is to minimize cost of capital. So indirectly, the value of the firm will get maximized. In this chapter, there are multiple capital structure theories. There's something called as common assumptions of theory. All that I've discussed when we did problem solving. So that segment of the discussion is not there in the summary material because it is discussed as part of the questions which we solve, where we have discussed about every theory. There is a net income theory, net operating income theory, Modigliani-Miller theory, common assumption, specific assumption. Apart from that, certain other points I have to discuss. One is called trade off. Trade off is basically balancing between high debt and low debt, or balancing towards more debt and lesser debt by considering the benefits of the debt as well as the cost of the debt. What is the benefit of the debt? Tax shield, tax benefit you get on interest payment. The cost of debt is normally on the lower side, whereas there are extra cost attached with debt. That is, if you borrow more, there is a possibility of we getting into financial distress. What is financial distress? Is inability to service our fixed obligation, technically interest obligation, and if the distress continues for a longer period, it can ultimately lead to insolvency. So what the theory says is, the benefit of debt, that is, we borrow more, the marginal additional benefit of debt will keep declining with the increase in debt. As you borrow more, the benefit of debt will keep going down. The benefit of debt will keep going down as we borrow more. Marginal benefit of debt will decline with the increase in debt, and the marginal cost of debt will increase. So it is essential that I have an optimum balance between benefits and cost. Pecking order theory. As the name indicates, there is an order in which you need to raise the money. The first priority is for retained earnings. Second priority is for debt. Third priority is for external equity. As per the theory, retained earnings is given first priority, debt is given second priority, external equity is given third priority. In this also, when should I raise debt? When should I raise equity? Debt can be raised when there is stability in business. When I'm growing, stability is there. Theory says you can raise debt if you're positive about the business performance. You are thinking that the company will perform well, stable, that time you can borrow money. And raise equity if you're doubtful about the business performance. Next, what are the factors which affect the capital structure? Capital structure is combination of debt, equity, and preference. What factors should I take into consideration? First factor is financial leverage. A financial leverage is considered to be favorable or unfavorable depending on the return on investment compared with cost of debt. We see this in leverages chapter. Return on investment compared with cost of debt. If the return on investment, if the return on investment is higher than the cost of debt, your financial leverage is favorable, please borrow money. If your financial leverage is favorable, please borrow money. And if the financial leverage is unfavorable, go for equity. Growth and stability. You are in a growing stage, stable stage, go for debt. Not a stable stage, go for equity. Cost. From cost point of view, debt is preferred over equity. Debt is preferred over equity. From a risk point of view, equity is preferred over debt. We saw risk, cost, control comparison in chapter 2. And from a control point of view, raise money in such a way that your existing dilution does not happen, preferably in the form of debt and preference. Equity may not be there. So if cost is your priority, go for debt. Risk is your priority, go for equity. Control is your priority, go for debt. If you are in a growing stage or a stable stage, raise debt. Unstable stage, go for equity. Favorable financial leverage, you can service debt, go for debt. Unfavorable financial leverage, go for equity. Limitation of EBIT and EPS analysis. In this chapter, we do an analysis called, we start with EBIT, less interest, EBT, less tax, EAT, less preference dividend, EAS, number of equity share, EPS. In this analysis, we used to find out a capital structure which maximizes the earnings per share. We used to find out a combination which maximizes the earnings per share. But the problem here is, while we are focusing on maximizing EPS, we are ignoring the risk element. What is risk element? Financial leverage. High EPS can result in high financial leverage also, but that is ignored in our analysis. This is one of the demerit of EBIT EPS analysis. Second thing is, EPS is more of a performance metric because it depends on operating performance of the company, and hence it cannot be technically a decision making measure. It is more of a performance measure and ideally should not be used for decision making. Last part of the chapter, over capitalization, under capitalization. Over capitalization means I have more capital than what is needed. This can lead to pressure because I have more money than what is needed. I'm not able to use the money properly, so this can lead to pressure in servicing debt and equity. There are certain things called as effects and consequences and remedies. I may discuss that, I'll show it in the bigger material. And under capitalization is a situation where the available capital is lesser. The available capital is lesser than the required capital, so I may not be in a position to do some of the projects which I want to do. This is part of the bigger material. So under capitalization, this is a frequently tested question. Under capitalization refers to a situation where the actual capitalization is lower than the proper capitalization, and over capitalization is I have more capital and earnings will be insufficient to pay dividend and interest. What are the reasons for this happening? I raised more money, borrowed huge amount, excessive payment for acquisition. If you raised more money, what is the consequence of this? I will not be able to pay dividend properly, interest properly. I may do window dressing and I may do reorganization because I have too much money. I have more capitalization. I may end up doing repayment of loans, buyback of shares, reduction in claims of debenture holder. All these remedies are available. Similarly, here in this scenario, they are talking about what are the effects of undercapitalization. Undercapitalization means money is not available. I do not have money here, so it leads to acute competition. High wages can be demanded by people because what is happening here is I do not have the capitalization is lower. Lot of reserves can be there, but capital is not there. Capital is not there. So considerable. In this case, I may go for splitting of shares. I may go for splitting of share. I may issue bonus share. I revising the par value of share, or I may end up taking more money because undercapitalized. Over capitalization is more dangerous for company, shareholder, and society because under capitalization, I do not have capital. I can raise the money. Over capitalization has a problem. Here, it is essential that I go ahead and reduce the available capital, otherwise I'll not be able to service the interest and dividend. With this chapter gets over. Okay, we move to chapter 6, which is on leverages. Again, a very simple chapter from a theory point of view. Leverage is focused on saying that there is an operating leverage, which is business risk. There's a financial leverage, which is financial risk, and together was called as combined leverage. So business risk is related to operations of the company from sales till EBIT, related to operations of the company measured through operating leverage. Measured through operating leverage arises due to fixed cost in the cost structure. Business risk, if you have high fixed cost, there can be an operating leverage and it can lead to risk for the business. Financial risk is the risk due to usage of fixed capital, primarily debt and preference. When I use debt and preference, it leads to a financial risk because I have to pay interest and preference dividend even when the business is not doing well. Interest and preference dividend has to be serviced even when the business is not doing well. This is measured through financial leverage, and when you combine them together, it is called combined leverage. Now there is a format. How is it calculated? All that I'm not discussing. Trading on equity. This is a very important term. What is trading on equity? Is the financial leverage is of two types. There's a favorable and there is a unfavorable. Favorable is a situation where ROI is greater than cost of debt and ROI is less than cost of debt. If you are earning more return on the investment used in the business, what is investment? Debt plus equity plus preference. If you can earn more than the investment used in the business, you pay part of it, you earn 15% on the entire investment, but to debt guys, you pay lesser. When you pay lesser, that excess goes to equity guy. So using very high amount of fixed capital, what is fixed capital? Is debt and preference, is called as trading and equity. The objective is that I can increase the return for equity shareholder. I can increase the return for equity shareholder. I am earning 15% on 300, which is 45 lakh. But I pay debt guys 100 into only 8%. So leftover 37 will go to equity guys on 200. So they will get a higher return. You can enhance the return of the equity shareholder by technically having a favorable financial leverage. Favorable financial leverage means ROI is greater than cost of debt. Then financial leverage has a benefit, has a disadvantage. Benefit in this situation if it's favorable, and disadvantage if it is in the other scenario. That's why it's called a double-edged sword. It is favorable if you earn more than the cost paid. This will increase ROE for the equity shareholder. But in case returns go down, then FL will become unfavorable. Financial leverage will become unfavorable, and in an unfavorable situation, EPS and ROE will be impacted significantly. Favorable situation, EPS and ROE will be benefited. Unfavorable situation, EPS and ROE will get impacted. So favorable versus unfavorable is a very important discussion in this area. Double-edged sword, trading on equity, and even in the earlier chapter we did talk about the favorable and unfavorable financial leverage. With this, chapter 6 theory gets over. Okay, we now move to chapter 7, which is on investment decision. Again, a chapter where primarily theory may not get tested, because our theory is chapter 1, 2, and 9 is the major one, but still let's discuss it. First is, what is capital budgeting? The term capital budgeting means budgeting for capital expenditure, are basically going through the process of investment. So here I identify a project, evaluate or analyze the project with the cash flows, and do lot of techniques like you have various techniques, NPV, payback, discounted payback, ARR, all these techniques you evaluate and then ultimately select a good project. Why is there a need for capital budgeting? Because capital budgeting normally involves huge expenses. It's not a small expense, it involves a huge expense. So if I am buying an asset worth 50 crores, 100 crores, 200 crores, 500 crores, as a company, I don't want to go wrong. I don't want to go wrong in a bigger decision. It is a substantial expenditure, and if I do any mistake in this, it can even lead to winding up of the company. It can even lead to winding up of the company if I end up making a mistake in this. So I want to be doubly, triply sure before taking up a project without any mistakes being made. Normally, it's an irreversible decision. Once you have invested money, you want to reverse it. It will involve lot of extra expenses. You have purchased a house for 2 crores and you suddenly don't like it. You are trying to sell it. You may have to sell it at a loss. It's a complex decision because there is a forecasting of future needed. So I need a systematic approach to do this analysis and it has a long term impact. Now, what is the process of capital budgeting? First is planning is which investment is to be done. Exactly the same thing will get repeated. Planning, identification of investment. Evaluation is what you learn in this subject, in this chapter, where you analyze the cash flows, calculate NPV, IRR, profitability index. Based on that, you select a project. With this, it doesn't stop. You have just selected it, you implement it. Review means see what is the progress and do certain correction. Review, compare actual performance with the forecast and do control is taking corrective action. This is called process of capital budgeting. Now, what are the types of decisions we take? One is replacement decision or a modernization decision, which is nothing but replacing an existing asset with a new asset. Replacing an existing means you're selling an old asset and buying a new asset, which is called replacement decision. Expansion decision basically means I am buying new asset. For example, Bharadwaj Institute has a branch in Chennai. I want to expand in a nearby location. That is called an expansion decision. Diversification, I diversify from CA coaching to something else, maybe a NEET coaching or engineering coaching. That is technically called as diversification. Mutually exclusive. What is mutually exclusive is if you have two options, that is project A, project B. Mutually exclusive means you can either do A or do B. You cannot do both. Projects are competing with each other. Selection of one will obviously lead to rejection of the other. Independent is there is separate evaluation. Every technique has its own rule. NPV says positive NPV, go ahead. IRR says greater than cost of capital, go ahead. Payback says lesser than target payback, go ahead. So independent, I'm not competing. If I'm a good project, I will be accepted, and if I'm a bad project, I will get rejected. Contingent is I am planning to construct a building in Chennai. 3 floors I will construct. If it is successful, I may construct 3 more floors, which is contingent on the first project. Investment in one project will need investment in other projects. Contingent is you have to first invest somewhere, and based on that, other projects will happen. We have seen various techniques. How to calculate, I'm not discussing it. I'm just discussing the advantages and the disadvantages. Payback method, very simple to calculate. It is an initial screening device. Initial screening device, very simple to calculate, but it ignores time value of money, ignores the cash flow which are beyond the payback period, and my emphasis on shorter payback period. There are certain projects which will not give me any money in the initial few years. I need to invest in for a longer period. So too much emphasis on short lived project, too much emphasis, so I may reject all those longer life, 10 year, 20 years life, 30 years life, 50 years, where the payback may happen in 10 years. A 20-year life payback happens in 10 years. So simple, it's a proxy for risk and it provides an estimate of time needed to recover. Payback reciprocal is inverse of payback period. You can call it as 1 by payback, or there's a formula also. The formula is basically when you do payback, we are calculating in how many years am I recovering the money, assuming you have a same inflow, assuming you have a same inflow. Initial outflow divided by annual cash flow. Every year, same number. This will tell me in how many years I'm paying back or I'm getting back the money. Inverse of that. Annual cash flow divided by initial investment into 100. ARR, accounting rate of return. As the name indicates, it is on profit, and that's the disadvantage. That is the bigger disadvantage because you are using profit, which is subjective in nature and not the cash flow. This and the payback both have same headache. We are not considering time value of money in the calculation, no discounting and other things. Lot of advantages are there. It is readily available data, and most of the organization, the listed companies, what ultimately matters to shareholders, profits. Profits are used for evaluating the performance of the management. Discounted payback method, same as payback method, same advantages, simple proxy cash flow, considers time value of money. That's an extra benefit here. It is considers time value of money. But the problem here again, short lived project. And what happens post payback? Nobody is worried because still payback only we evaluate. Once the payback is attained, we are not really bothered about the cash flow. NPV technique, I think the most important technique, which is in line with the wealth maximization principle. Time value of money is considered, entire cash flow is considered. Disadvantages, I really don't feel it is a disadvantage, but ICI Metal says complex to calculate, not really. Once the cash flows are there, it is easy for us to calculate NPV. But one disadvantage, you cannot compare projects of uneven sizes. You cannot use it to compare projects of uneven investment. For example, 10 crore NPV can be 1 crore and a 2 crore project NPV can be 50 lakh. NPV technique will say this is better. 1 crore is better because absolute amount of NPV. Whereas 1 crore on a 10 crore looks to be bad as compared to 50 lakh on 2 crore. Uneven investment comparison is little difficult. Profitability index kind of takes care of this issue where you calculate the ratio, relative measure useful during capital rationing. Capital rationing is, it refers to a situation where I do not have adequate money to do investment, so I have to go and pick and choose. I have to go for pick and choose. There are certain disadvantages. It indirectly fails during capital rationing. Fails during capital rationing, which is indivisible project. There's a divisible project and indivisible. Indivisible project, when you sold, you don't go by the profitability index. You go through an approach called as trial and error method there. IRR, IRR has one benefit. The biggest benefit is it is a relative measure, so can be used to compare projects of uneven size, cash flow, time value of money. But some projects may not even have IRR because you are not able to get the IRR of the project. Technically, very high negative NPV kind of a project may not have IRR. And sometimes multiple IRR can also come. It depends on how the cash flows are given. So that is also possible. And it says this is where the NPV logic comes. Project with higher outlay and lower IRR may be better than a lower outlay and higher IRR because this will have high IRR. This will have, sorry, this will have high, the second one will have high IRR. The first one will have low IRR. The second one will have, in this example, low IRR, high IRR. IRR will say this is better, NP will say other one is better. Ultimately, what really matters is how much money is available. And if I have to do only one of the two, I may end up investing 10 CR and earn 1 CR if I have money available. So sometimes it is possible that higher outlay and lower IRR. NPV versus IRR conflict. Why does a conflict arise between these two items? One, size disparity, 10 CR versus 2 CR project. Second, life disparity, a 5-year project and a 10-year project. Both obviously, some 5-year project and a 10-year project, NPV will be better in one scenario, IRR could be better for the other project, and then we do equated annual benefit or equated annual cost. Timing, some cash flows, some project has major cash flows in beginning, some project major cash flows in end. Again, this can lead to variation. Again, whatever I'm discussing in this chapter is primarily done when we solve the question, but more of advantages and disadvantages discussion. How it is calculated, if they ask in exam, you'll have to do it from the questions which we have solved. With this, chapter 7 gets over. Okay, now we move to chapter 8, which is on dividend decision. Some theory questions have come from this segment in the exam. Forms of dividend. How can an organization pay dividend? The best way is cash dividend, which is the common way of paying dividend. I declare an interim dividend or a final dividend and pay dividend to the shareholders. Whoever is in the register of members, we make a payment to them. Stock dividend is making bonus issue. Making bonus issue. Whatever shares we are having, we allot extra shares to the shareholder. In this case, extra shares are allotted. Shareholder does not get any money. And the third option is share repurchase. are technically buyback of share. You go for buyback of share, by which money is distributed to select set of shareholder, whoever is opting for buyback. What is the importance of dividend policy? It is a part of my financing decision. It is a part of my financing decision, because financing decision means where is the money going to come from? Debt, equity, preference. In equity, we have internal equity, external equity. So retained earnings can be used for meeting the future investment opportunity, and hence dividend decision is also a financing decision, and it will impact my raising of debt, equity, and preference. Also, wealth maximization. Shareholders expect that companies pay dividend, and there are dividend relevance models like your Walter's model and Gordon's model, which indicates that what is the impact of dividend on the wealth of the company or the share price of the company. So it is essential that we fix an optimum dividend payout ratio. Now, for that comes the next point. What are the determinants, or what are the factors which impacts the dividend decision? First is requirement of funds and investment opportunity. There are a lot of companies which do not pay dividend for even 10 years, 20 years, because they continuously keep investing. I am a pharma company. I want to keep investing for R&D purpose and keep coming out with new products. So if that is the requirement, I may not pay dividend. What are my shareholders expecting? Do they want more dividend, or do they want share price appreciation? Because if I don't pay dividend, the value of the dividend is indirectly reflected in share price. Taxation impact, against dividend versus the dividend impact versus your in capital gain rates. If dividend taxation rates is on the higher side, I wouldn't pay dividend. Dividend tax rates are on the lower side, I may pay dividend. Legal constraints, your company's act had certain restrictions, you'll have to follow all those restrictions and then pay the dividend. ROE versus KE, this we have seen when we did Walter's model or Gordon's model. ROE greater than KE, 0% dividend. ROE greater than KE, 0% dividend. And if ROE is less than KE, 100% dividend. Trend of industry. How are the companies in the industry paying dividends? And are there a lot of expansion happening in the industry? If a lot of expansion is happening, I need funds, I may not pay dividend. And if a lot of expansion is not happening, I may again go for high dividend payout. Impact on WACC. Now, this is relatively very important point. What is impact on WACCs? Whatever money I need for expansion can come in the form of debt, equity, or preference. Ignore preference. Let's assume debt and equity. If debt is available, then debt normally has a cheaper cost. Please use debt and pay dividends to the shareholder. But if you're going to use equity, equity has a higher cost. Is it feasible not to raise equity but to retain the profits? To retain the profit. If we are raising debt, cheapest cost, please pay dividend, no problem. But if you are going to issue external equity, is it feasible to retain earnings? These are the factors which determine, and these are next item is practical consideration and dividend policy. Technically, according to me, both are same determinants, and now practical consideration, more or less interrelated only. You will see first is financial needs, which is requirement of funds. Mature companies do not have major investment opportunity, will pay high dividend. A growing company, a newer company, and technology company, an AI company, which is just now started, they will have high investment opportunity, low payout. TCS, Infosys may not have that many investment opportunities, so they may go for high payout. They are a mature company. Constraints, we have already seen legal constraint can be there, liquidity constraints can be there, capital markets access, that is, can I raise money or not in the form of equity? So all these factors have to be taken into consideration. Expectation of shareholder, desire of shareholders. Do they want dividend or do they want capital gain? Depends on the taxation side. If the taxation is on the higher side on dividend, no dividends are to be paid. Taxation on the lower side on dividend, pay dividends. Stability in dividend. Many people expect a company to pay a stable rate of dividend. Continuously, you will have to pay dividend. So I can go for constant dividend, 10 rupees every year. constant payout ratio. What is payout ratios? I pay 40% every year, constant payout ratio, or a constant dividend and some extra dividend may get paid. So I may follow either of the policy. Lot of companies follow a constant payout ratio. As profit increases, they'll increase the dividend. The other two elements which are there in the chapter is stock split. What is stock split is, I have one share of 10 rupees face value. I'll convert this into 10 share of 1 rupee. 10 share of 1 rupee. So indirectly, the share price in the market will also become divided by 10. Face value will also become divided by 10. Number of shares will increase by 10. Process of splitting a stock of higher face value into multiple stocks of lower face value. This can improve the liquidity. What is improve the liquidities in the market? You see one company called this MRF, which is around 1 lakh rupee. I want to buy MRF share, but my budget is only 10,000 rupees per share. So I'll not buy MRF because it's 1 lakh rupee. It is 1 lakh rupee. If they do a split and make it as 100 shares of 1,000 rupees each, when face value goes down, market price will also go down. 100 shares of 1,000 each, I will buy 10 shares of MRF. Now I cannot buy MRF share because 1 lakh is outside my budget. So small investor will become interested, and that is also a disadvantage because it will attract non-serious investor due to lower price, and technically there is no any benefit to the shareholder. You're just splitting it. Earlier it was 10 shares of 1,000 rupees. Now it will become 100 shares of 100 rupees. So technically there is no benefit. Why to incur all this cost for split process and attract the non-serious investor? Last part is buyback. You would have learned this buyback angle in your accounting also. Here companies are buying back their own shares. This can be either through an open market or through a tender offer. This will impact my net worth, will impact my book value per share, and will decrease the number of equity share. With this, PAT also can go down. EPS can get impacted. All this we have seen in one question. PAT can change, EPS can change, net worth can change, book value per share can change. But purpose of buyback is to give back to shareholders whenever I have lot of money available. Rather than paying in the form of dividend, I pay in the form of buying back the existing share. This can also be a remedy for over capitalization. When I have more money than what is needed, I can pay back in the form of a buyback process, or I pay a huge dividend. Huge dividend, I don't want to do it because once I do, next year also again more dividend will be expected. So I don't want to do that. I just want to do a buyback. Buyback is buying back the existing shares either through an open market or through tender offer. And in accounting, you would have learned certain rules, regulations around it, and the accounting aspect, journal entries and other things. With this chapter gets over. Okay, we are moving to the last chapter, which is on management of working capital. A little bit theory heavy chapter. If time permits, you can go through the detailed theory video at 2x speed also in this chapter because there the coverage is in depth. Here I've tried covering only the important points. Some extra explanation can be there in the main material. That's why, as I say, every chapter you should watch only with the main material, that is the initial set of pages, and you can keep reading newer extra points so that things register for you. First is, what is the type of working capital? One, based on value. Either there is a gross working capital, which is all current asset, and net working capital is current asset minus current liability, self-explanatory. Based on time factor. What is based on time factor? Is one which is permanent. Permanent means it will be there always. It will be there always. Some requirements of working capital will be there always with the company. And temporary working capital. The temporary working capital, because suddenly there is a fluctuation in demand during Diwali season, during Christmas season, during New Year. I may maintain more inventory because there is a fluctuation in demand. I may have more debtors because there is a fluctuation in demand, which is called temporary working capital. What is an optimum working capital? You need money for smooth operation. You don't want very high working capital. You don't want very less working capital also. Very high working capital, you are unnecessarily blocking the resources. Very less working capital, you will not be able to run your smooth operation. Theoretically, they say this, but practical well it can change company wise. 2 times of current ratio and 1 time of quick ratio. If this is there, that is technically called as an ideal or optimum working capital. Next is what are the determinants and factors. Both are similar. We have the same thing, determinants for dividend policy and practical consideration. Here determinants and factors. One is we are seeing the various current asset and current liability. Policy on cash maintenance. If you are a company which maintain a very high cash, there are reasons for maintaining cash, something called as a transaction reason or a precautionary reason or a speculative reason. You'll understand as we proceed. So cash maintenance policy. Inventory, what is my raw material stock holding period, 1 month versus 2 months. WIP production period, FG stock holding period. Debtors, what kind of credit policy I give. Creditors, what kind of credit policy I can get. Apart from this, seasonality in demand or production. In case there is a seasonality in demand, an organization may have good technology by which they can produce very high during the time of demand, or they produce throughout the year and maintain inventory. So seasonality in demand or production. Same demand versus the production capacity. Demand fluctuates. My capacity, can it fluctuate in line with the demand? And inflation, if there is high inflation, obviously your inventory will increase, debtors will increase, creditors will increase, indirectly working capital will go up. Factors influencing working capital, nature of industry. Some industries you need more working capital, example consumer durables industry. Some industry you need less. This can be type of product also or nature of industry. Consumer durables you need more working capital. Perishable products you need less working capital. Nature of industry, type of product. Manufacturing, more working capital because you need raw material, WIP, FG. Trading, only you need FG. Service, only some consumables are needed. So working capital will be higher for a manufacturing company. Credit policy, if you give longer credit, more working capital. Shorter credit, lesser working capital. Volume of sales, if this increases, working capital will increase. Volume of sales decreases, working capital will decrease. This is first segment, basic discussion. Then focus is on cash management or treasury management. Treasury management is managing the cash and allied areas to cash, which is Indian currency, foreign currency cash management. Funding management is when do I need money, from where do I raise money, how much do I raise money, at what cost do I raise money. Managing the cash flows of the company, inflows and outflows through a cash budget or a cash flow statement. And a corporate finance, this is practically a separate division which normally manages the mergers and acquisition. What is the goal? I want to maximize the return on the available cash. I can use cash for multiple purposes. You'll understand as we proceed. So use the cash in such a manner that you can maximize the return, minimize the interest cost. You don't want to borrow money, accelerate your inflow, decelerate your outflow, accelerate your inflow and reduce your outflow or make the payments later without any impact on goodwill. Adequate cash for meeting expenses or contingency. Cash management. What is cash management? At my home, there is a cash management which is done by my mother, managing the inflows and the outflows within and outside the organization. Goal remains same, maximize the return and adequate cash is available for meeting expenses or any contingency. Why do I need cash? At personal end, I need cash for transaction purpose. What is transaction purpose? I buy some fruits, vegetables, food, petrol, transport. So for daily expenses and debt repayments. Speculative is you are keeping money, suddenly you get a lucrative opportunity. Suddenly you get a lucrative opportunity. In case you get that speculative need, that cash will help you in sudden there is a price fall which has happened in the market and you want to benefit from the price fall. Precautionary need, contingency, anything may happen in that speculative trend can also be there, but precautionary is more or less any unforeseen event has happened and you want to take care of that. Cash planning. What is cash planning? Is managing the cash inflows and outflows through the process called as a cash budget. Through a process called cash budget. The cash budget will forecast various transaction needs, that is your day in day out requirement, how much surplus can be there, and invest that surplus or use it to get some discounts. Apart from that, cash budget indirectly will keep in mind a speculative need and a precautionary need. I may maintain some cash accordingly. Managing cash collection and disbursement. Cash collection is, let's assume I'm a telecom company. In a telecom company, customers are going to pay. Earlier, what used to happen is there used to be a physical bill used to go, and people used to deposit checks. The days when landline and all was there. So accelerating inflow through concentration banking. What is concentration is, if customer are depositing checks, having multiple places for collecting customer check. Now online payment and all have come. This is not that critical. Lockbox system, customer can deposit the check. I stay in an apartment, some 1,000 families are there. In this society, they can put a lockbox and we will deposit all the check. And decelerating, accelerating inflow, decelerating cash payment. This will give me certain extra inflow. How can I decelerate? By playing around the float. What is float? Is the gap between the receipt of the product and the payment being made. One, there is a normal credit. Apart from that normal credit, what can happen? There is a billing float. What is billing float? Is I bought some product, but the bill did not come on time. If the bill does not come on time, obviously my payment will get delayed. So time taken by the seller to send the invoice. This is billing float. Next is mail float. What is mail float? Is if there is a courier happening of check from our side, no concentration banking, no lockbox banking. I'm a customer. I'm couriering this check to my supplier. So I want to decelerate the payment. The courier will reach after 3-4 days. After the courier reaches, this guy does processing of the check, and he takes another 2 days to deposit the check, and banking takes another 2 days to fulfill the payment. So time taken by the seller, first he is taking time. After that, I give the check, but I give it by courier. He receives the check but deposits after 2 days, and bank gives money after 2 days. So ultimately, from the time I got the bill and the payment being made without any credit, also I can get 10 days credit. Optimum cash balance. One is through Baumol model. You would have learned the square root of 2 into annual demand for money into the transaction cost per transfer divided by interest cost per rupee per annum, which is same as EOQ. Second is there is a Miller or cash management model where I have a minimum limit, that is a lower limit, and an upper limit. Whenever cash flow touches the lower limit, I will withdraw money and increase the balance. Withdraw money from something called as marketable security and increase the cash balance. Whenever it touches the upper limit, I'll deposit money. I'll deposit money into the marketable security. This is another approach. Latest developments. Some of this are very good developments which are ensuring that all those float is eliminated, logbox eliminated, concentration, electronic fund transfer. Now there is something called as e-payment, e-invoicing. So there is no billing float, there is no payment float. Immediately do electronic fund transfer. We also have zero balance account, which can help us in managing our business without any money being blocked. Money market operation. What is money market operation? Is less than 1 year for any short term investment. Petty cash impress system is I have a main cash and I have a petty cash. From main cash, I'll transfer to petty cash, use it for petty cash expenses, and impressed it. Impressed is you pay again whenever it is needed. If you have any temporary cash surplus, you can do money market operation and invest there. Electronic cash management system. Transfer of data, invoice, purchase order, any document comes in the form of mail, as well as funds through information technology. Transfer of data as well as funds through information technology, using the information technology to do the operations. Virtual banking. What is virtual banking? Is an ability to perform my banking. I have never gone to my bank. It is almost 2 3 years by I have gone to my bank because I'm able to do all my banking operation without physically going to the bank. I use ATM, I do internet banking. Very rarely I go to the bank, so that is called virtual banking, able to perform all operations without even going to the bank. There is a detailed explanation on each of this. You want to know in depth, obviously you would have by now looked at the detailed material. So as I explain, you will have keep reading it. So you will learn more points. Marketable security, as the term indicates, marketable means short term, readily converted into cash. And this can play the role of cash itself. This can play the role of cash itself. Marketable, ability to convert into cash. Safety, there is no variation. It's like an equity share. You would have learned something called as cash and cash equivalent in accounting standard on cash flow statement. So there is something called as cash equivalent. So whatever characteristics are cash equivalent can be like a marketable security. Receivables management, managing the receivables of a company, ensuring I do not have a very high receivables, I do not have a very low investment in receivable, and I want to maximize the return on investment in debtor. Technically, I want to maximize the return on investment. Technically, highest net benefit. We have problems where we have sales, less variable cost, less fixed cost, gross benefit we used to calculate. Then we used to deduct some interest cost, bad debt cost, maximize the return on investment. 3 points you have to be aware. One is what is the credit policy? 1 month credit, 2 month credit, 3 month credit, 5 month credit, and then collection policy, which is control of receivables. Credit policy is one, and collection policy is controlling the receivables. Credit analysis. What is credit analysis? Is analyzing the payment pattern of the various customer category, and based on this I may give more sales to some customer and lesser sales to fewer category of customer. Now, what are the factors determining the credit policy? The benefit. What is the benefit? Extra sales, extra contribution. Extra sales gives extra contribution. The benefit should be more than the cost. What is the cost of giving discount? A cost of giving credit, cash discount can be there, bad debt can be there, credit admin cost can be there, interest cost can be there. All these extra costs I incur. If the benefits are more, give higher credit. Benefits are less, don't give credit. Pledging versus factoring versus forfeiting. This can come in exam. Pledging means I have some receivables with me. I go to the bank, give them the bills, give them the bills or give them the receivables. Bank will analyze my receivables. If they are comfortable with this receivable security, they may give me a loan against it. They will give taking a loan by pledging the receivable. Pledging is I'm giving the receivables to them. Bank will take it as a collateral and give me a loan of 50 to 90%. Not all accounts, acceptable accounts. Factoring, it says already explained. Basically, it is explained as part of the theory discussion. But what is factoring is? It is an arrangement by which I sell my receivables to an outside agency called factor. He takes care of collecting the money and he gives me an advance immediately. Some 10%, 12% he may retain, which is called reserve, and that will be paid once the money is collected. It can be with recourse, without recourse. Without recourse means bad debt risk is with the factor. With recourse means company continues to have the bad debt risk. Forfeiting is normally used in export transaction. Is used in export transaction. Here I discount the bills of exchange on mostly non-recourse basis. What is non-recourse basis? Is the bank will bear the risk, but bank may not bear the risk directly. What bank will do is first I sell the goods. After I sell the goods, I'll ask for a letter of credit from my importer. Letter of credit is a guarantee given by the importer's bank. Letter of credit is guarantee given by the importer's bank that the importer will make the payment to us. In case importer does not make the payment, the importer's bank will make the payment to. So it's a kind of a guaranteed instrument. I take this letter and give it to the my bank. He gives me money. An importer will make payment to the exporter's bank. If they do not make, importer's bank will make the payment to exporter's bank, and then the importer bank will take care of collecting it from the importer. So This is another approach, forfeiting. Certain new innovations are there in receivables management. More or less it is self-explanatory. One is re-engineered receivables process, centralization of collection, so that you can do accelerate the inflow. Use of technology, e-invoicing, e-payments, having a receivables collection policy, having a receive appropriate credit policy, credit limit, credit analysis. Monitoring of receivables can be done through something called as an aging schedule. Through an aging schedule where I classify the receivables into 0 to 30 days, 31 to 60 days, 61 to 90 days, 91 to 180, 6 to. So this will tell me where is the money stuck, what time period. Second, average age of receivable, technically called as debtor days. You would have learned this in the ratio analysis chapter. Debtor days we calculate as 365 divided by debtors turnover ratio, and debtors turnover ratio we have understood the formula there, which used to be something called as credit sales by average receivable, and having a proper collection policy. So with this discussion on receivable side is over. Now comes the payable side, where I have trade credit. There is a benefit of availing trade credit, and there is a cost of not availing trade credit. The cost, sorry, there is a cost of availing and cost of not availing. Technically, if you don't avail, indirectly we have certain benefits, and if we avail, we have certain cost. First thing is, whenever I want this trade credit, I may not get discount. Second, there can be a reputation issue also, saying that this company normally takes longer time to make the payment. In EOQ, you would have learnt that if you buy in excess of EOQ, incur extra cost. So I am unnecessarily buying more because I wanted credit period. And managing cost, like we have debtor administration, there can be a creditor administration cost. You have to make payments to the creditor every 3 months, every 6 months, every 1 month, every 2 months. Different creditors are there. But if you don't avail, these all will become benefits. If you don't avail, these all will become, you may get a cash discount, you can have a better goodwill, you need not have a purchase consideration, no credit administration cost, but I have to incur interest cost, because trade credit is an interest free loan which will be replaced with a normal loan. So is it okay to pay interest on a loan and get benefits like cash discount, improved goodwill, no purchase condition, no credit administration cost? Spontaneous sources versus negotiated sources. Spontaneous sources of finance are those which arise as part of my routine operations, like creditors, outstanding expenses, outstanding wages. Whenever I do operations, automatically this will arise. Negotiated sources is, I may have to negotiate with a bank and get a cash credit facility, bank OD facility, short term loan. That is called negotiated. Spontaneous means naturally arises in the process. This you have to take some effort and get it. Various sources of finance, we have discussed this in the chapter 2, and here also the same items are there. Trade credit, which is sundry creditor; bills payable, which is a negotiated bill of exchange; outstanding expenses; intercorporate loans and deposits can come; commercial paper, which is released by or which is issued by high credit worth companies; funds which you generate from operations; public deposit; bills discounting, bills rediscounting. All these are various sources of finance. With this, I have discussed all the chapters in depth. Again, any chapter you need more clarity, you should look at detailed video. You should look at detailed video. I'm attaching the playlist of the detailed video also. Go through the detailed video if you want more clarity, and if you are still comfortable with this, then this itself is sufficient. With this, I complete my discussion of theory videos. Thank you, friends.